We are live again. Good
Awesome.
evening.
Good evening. How are you, sir?
I'm doing wonderful. How about yourself?
Doing great. Getting ready for Thanksgiving tomorrow.
Awesome. How's your family getting ready for it?
We just got a turkey just to pop in the oven. We got a plenty of pie. Somehow we ended up with more pies than we thought we were going to have, but we're going to dig in and eat those and just buckle down and make sure we finish off the pies.
Awesome. I hope you guys have a wonderful family time. These holidays are great, of course, for those, but I appreciate your time for hopping on today again. We will be going on to today where we left. I remember last time we spoke about was more into the aspect of syndication and lending in there. Let me pull this one up. I remember we had some chicken scraps where we ended up in a situation where, hey, what's going to happen where the lending comes up? So we came up with a very interesting GP who is very smart. So instead of just erasing that money, part of that he raises from LP, and the part of it he also lends at second position. Now, we were at a position where we said that, hey, you could also lend this money. In some cases, there's going to be a note to this GP's entity or even against the property. So there's a lot of different ways we spoke, and we also spoke where it becomes active income and passive income. Of course, if that's why we were really concerned that, hey, when you're lending, if it is a sporadic lending that you're lending on a part of deals, that's different than being in the business of lending. Correct me if I'm wrong. When someone becomes in the business of lending, that's an active income.
Yes, it's going to be active income. So you need to be careful there that you're not exceeding the number of loans that you can. And I'm not sure if that's by state or federal. So we'd have to do a little more digging into that one.
Absolutely. So whichever state you are, make sure to check with your attorney, your CPA, whoever you're working with, to make sure that you're below that active income if you want to have those passive losses against your passive income.
Yep.
But if your goal is to eventually make that income as an active, make sure you are on the GP side, because for GPs in this kind of structure is going to be an active income. So that's where it becomes what you can or cannot deduct uh, on your particular area. And same thing as someone goes to is, say for example, instead of the syndication deal, it becomes a JV deal, where multiple people comes in. So here's one person, here's another person. They lend money, put their resources there, buy this piece of property. In this case, what happens, Chris, is if they become a form an LLC and buy this, now this one is taxed as a partnership.
Yes.
And now this one, say for example, whatever income this one makes, is going to be issuing K1s respectively.
Absolutely.
So help me understand what happens in the taxes, in the benefits, in the depreciation, passive and active for us.
Okay, so what's going to happen is that with the active, the person, the GP, as Tusuf sitting here saying, is that you're going to be able to, you're going to K1, you're going to see things like the income, the rental income, as well as the sales, the 1245, 1250 sales are going to pass on to you on on that K1. Now, depreciation is going to be baked into the K1 because depreciation is going to be taken on the partnership. So that's going to be baked into either the rental income that you're getting, or it's going to be the business income that you're getting. That's going to be box one on a K1, but that's going to be baked in there. But then what happens is that if you have if you are a general partner and you have losses for your active income, that's going to roll forward on your 1040, and you're going to be able to take those up to $3,000 a year. Now, if you're passive, you're going to, if you're a passive investor in this, is that you're going to need some passive income of which to use this against. Otherwise, you're going to be hitting that limit of the 3,000 as well. But if this is the business that you're in, if you are a real estate professional, there are rules around saying that you can take more because this is the business that you're in. Tusif,
Awesome.
anything to add to that?
Repeat that again.
Did you have anything to add to that?
Yeah, so I'm just gonna explain, try to make it as a more dummy version.
Okay,
So
good.
here's the thing. Chris is great at explaining. Here's for whoever is listening, if you have been dummy like me, these are the three elements that you need to realize. Chris mentioned 3 points. One, on a general case, you get $3,000 in losses. Okay. This is if you don't own more than 10% of the property and or you make more than $150,000.
Yep.
So if you are anywhere between making, say for example, you are an engineer, doctor, whoever you are, or IT specialist, you make as a W-2 more than $150,000. You cannot take more than $3,000 of loss. That's called the capital expenditure, capital passive losses. Not capital, it's a passive loss. So the second element is if you are anywhere from $100,000 to $150,000. If your income is between 100 to 150, then you can take up to $25,000 if you own more than 10%.
Yep.
So these are the two big elements for you. And the third one, as Chris said, is real estate professional. Or if you are using STR loop, we did discuss, I'm not sure if we discussed it previously, but we will discuss, if not, is these are the three situations where you can typically take, or how you typically take passive losses. On a general level, you make a lot of money, you're limited to three grand. For people who make between 100 to 150K, that's a phase out limit. If you own more than 10%, it goes up to 25,000. And if you are qualifying, or you or your spouse, legal spouse, qualifies as a real estate professional, or if you guys are having short-term rentals, and then you have more than 100 hours, make sure to check out the IRS publication and qualify for all of those, is then your depreciation, the passive loss, becomes limitless. So that's how pretty much Donald Trump was able to take billions of dollars deductions down to $750 in payments. And in these cases, as Chris was mentioning, is these are the rules that depreciation is going to be flowing, or passive losses are going to flow through. All right, now let me ask you this, Chris. Say, for example, this individual qualifies for REP, but this individual does not. Can this individual take more depreciation from this particular property than this individual for LLC structure?
The LLC structure, yeah, you and I were talking about this before, and it really depends on how the partnership or agreement is set up and what can be done. And I'm would be kind of curious as to why a real estate professional would get into it with a non-real estate professional and expect that, or the non-real estate person thinks he's going to get the same treatment as a real estate professional. So that behooves you to sit down and draw out a good partnership agreement to say who can do what and who's what have you. Now, folks, when we're giving you this advice, this is kind of a conversation starter to have with your CPA. This isn't tax advice. This is just general information so that you know, have some things that you can talk to your CPA intelligently about. Or if your CPA just looks at you like, I'm not dealing with you, come talk to Tusif and I, because we'll talk to you like you're a normal person.
Absolutely. That's why I make it so much weird questions. Even if you don't think it's dumb, it's definitely weird. Like, why would someone come into this kind of situation? But legally, you can. You need to be sitting down, having your lawyers draft up the proper partnership agreement. But you can. But essentially, what's going to be the best is if most of the depreciation goes to the rep. But of course, if you do come to this location, the income and whatnot, the losses are going to carry forward. So here's what's going to happen is you cannot really, even though you can take it, but you cannot really use it up until these three conditions.
Right. And really, it's also just a matter of, it's not anything that's in a partnership agreement that says you are a real estate professional. I hereby dub thee real estate professional. It's what you do. There's going to be tests during the year that says that you are doing this or have done this. So that's what's really going to determine if you can. So that's kind of why I was sitting here saying, well, why would you get in this partnership if this one partner is doing everything and being able to claim they're a real estate professional? What are you as a non-professional providing to this that you would merit you being able to do it? Why not be a real estate professional yourself so that you can take advantage of this?
Absolutely. So folks, this is where the tax planning comes in. You need to sit down with someone like Chris, who is really good at picking out KPIs and planning for finances. He's a CEM, CEM or CME. I forgot. Sorry about that.
Just if I get so many, I get confused about it myself. I'm a certified management accountant, CMA, as well as certified financial manager. Accountant. Yeah, so I've got a lot of tests I took, and my wife has said no more tests for you. So we're done.
Absolutely. But the good thing is, if you need some sort of management accounting, reach out to us. Let's have a look into it and see how we can potentially maximize the profit. Otherwise, if you just for the heck of taking it, it's not always the best. Now, let me ask you this. I know we spoke about LLC. This is typically what I personally like. What if someone came in and said and smacked that, hey, you know what? We're going to do a C Corp into it as opposed to an LLC. How does that work out?
In terms of they're going to be a corporation versus just being an LLC or
yes. So now, instead of these people owning an LLC, they own a C Corp. And instead of ownership, now they're issued stocks.
Yep.
So what happens if with the depreciation, the income, and the sale of this property?
Okay. So basically think of a partnership or an LLC, S Corp, being kind of like a hose. It's kind of feeding into your personal return. But a corporation is kind of like a neighbor's pool with a huge fence around it. You're not going to be able to get in or out. You're going to be in there. So anything that happens under the corporate umbrella is going to be there as part, and you're going to be taxed at 21% on the income, the gains, what have you, is going to happen there. Nothing's going to pass to you unless you're issued dividends. And dividends is what's going to be showing up on your tax return, not any kinds of gains or losses. They're going to be contained within your neighbor's pool. So they're not coming out into your little floaty pool, like we used to call them, I guess, back in the 70s.
Kiddie pool.
Kiddie pool, thank you. So it's all going to be contained in there, and then any gains or losses are going to be held within a corporation. And all you're going to get is you can probably be paid a salary, or you're going to get dividends based on the meeting. Say if Tusif and I were corporation, we'd be sitting down, we'd find a great halal place, and we'd be sitting there munching and making a decision about what we're going to pay ourselves in dividends, write it down, put it into corporate minutes, and say, this is what the dividends are going to be for this. So everything that happens when you switch from this to a corporation, everything that happens within a corporation, nothing's going to flow into your personal return.
Awesome. And I actually came across this situation today. We are talking about a portfolio loan in Georgia, more than 100 units, where for some reason they have it as a C corp. The
Okay.
issue is they are trying to sell it, but when I was thinking of seeing if I could propose them, hey, instead of doing sell it together, why not 1031 exchange?
Yes.
So help me understand, how does the 10, if and how would the 1031 exchange work in C corp?
My understanding is pretty much the same way. It's just having a property that's going to be there, and you need to have an intermediary. You need to have the properties picked out, and just make sure that you again contact the intermediary before you do anything to have everything set up, and everything's going to be done within the corporate. We'll call it the corporate veil.
Awesome. So what Chris meant is a very important thing. That means there is a veil between you as individual. Oops, too much of an individual, but you and an individual are different than that C corp. So what ends up happening is the individual or the family or whatever you are, if you have properties in C corp, if you do want to 1031 exchange, all of that has to have happen inside the C corp. You personally cannot sell something and buy a second property and have it. In that case, you have to go through a significant amount of tedious legal process. As Chris also mentioned, you need to have a certified intermediary who's going to help you out with these. But in most cases, you cannot just have it and go find another thing. So let me ask you this, making this more interesting and realistic, Chris, is, say, for example, instead of selling the property, this individual who is one of the partners, he wants to sell the stock of this C corp. Now, this becomes a capital distribution for him.
Yep.
Can he do a 1031 exchange on the ownership or the capital distribution of the stock of a C corp?
You would need to find another C corp. We need to find corporation. So yes,
Awesome.
it's good stock. It's stock for stock. So yeah, find an intermediary who's going to be able to do that to help you out with that. But I would kind of wonder why you would, if when I talk to my clients, because right now we're recording this, it's late November, and we're heading in December, and people are looking for ways to save money before taxes, and they say, well, should I go out and buy a Tesla so I have this big tax thing to deduct? And like, no, don't ever make a transaction just for the tax effect. Always make it because it's going to put more money in your pocket. And Tusif's and I's goal is to make you so rich that this is not, it's a pittance. We're not going to worry about that. So if you want to do the exchange, that would be the time to sit down with the CPA and an attorney and say, all right, what are you gaining out of this? If you're just wanting to make, we used to call it in corporation a busy work. So if you're just trying to make busy work for yourself, why? What gain are you getting out of it? That would be the first question I would ask on that.
Absolutely. That's a great point. So, folks, just to summarize here, don't do something just for the heck of taxes. Do
As my
something
dad would
for
say, don't try to
business.
get cute.
Just do it for the business expansion, business growth, whatever you want to say, making money, actual legal thing, and subsequently do it in a tax efficient way. Help us understand. I was reading about this. There's something called, if someone were to transfer something from their personal name to LLC or a C corp, there's something called step up basis.
Right. So that's, we've been talking, Tristan and I have been talking about this because we'll talk outside. This is not the only time we talk to each other. But what happens is that you have something that if you own and say you want to pass down to your heirs. The example I think Tristan and I used in a prior show was that somebody bought a house in the 1970s here in Northern Virginia, and now their grandparents want to pass it on to them and say, well, I'm just going to sign this over to you. No, 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 stop. Grandma, stop, please stop. Aunt Ethel, stop, please. What happens is that when they die, the basis moves up to what the property's value is when that person passes. So that instead of being the 1970s prices, it's the 2023 price. So that what you could do is when the property passes, you automatically can move that. You could go ahead and sell it, and your capital gains hit would not be as big.
Yep. So folks, that's a great point to consider. Corporations don't get the step-up basis.
Correct.
But LLCs do. So what happens for you, and when you're going to be selling it, you're going to be paying a huge difference in terms of gains if you are selling it from a C Corp. So make sure to understand your structure. If you have not seen our first video in the series, go back and check. We discussed different strategies and different elements. So just to summarize here, I know we have been into so many things here. These episodes have been totally jam-packed with strategies. First, summary of so much is we recommend having LLC for real estate properties and capital assets, if possible. If you are into a corporation, sometimes people do that for reducing getting some depreciation. Okay, but remember, you as a person, you're not gonna get that. It is gonna get stuck if you're in a C Corp to as Chris mentioned, as neighbor's fence in terms of capital, corporate veil, or whatever you want to say that. So whenever you're doing this, understand that if you're LLC, you can essentially distribute it. For a C Corp, it actually stops here, and whatever is here, then it gets distributed however you want to get it distributed out. So that, and all of these need to maintain these three elements in terms of passive losses. Anything I missed so far?
Nope, doing good, Tusif. Keep going.
Awesome. So next, say for example, someone bought it. We bought this one with whatever creative structure. Now what we want to do is this one has a mortgage. So say for example, we come up with a house we acquired subject to. And we want to sell it as another mortgage. Now, instead of having a sale of property at the same time, we become the lender of the property. And what we end up having is another individual with a note. Oops. So what we hold is a note in second position, which is going to be held by us or our LLC. And this property goes to the individual end buyer who is going to be living here with his family. So what happens here is we're literally wrapping a mortgage on top of another mortgage. Chris, help us understand, how does the taxes work in this case?
Well, the taxes are going to work that you as the lender, you're going to basically sell the property and the mortgage comes with it. And then the payments that are coming from the person who bought it from you are going to include basically the mortgage payment. You're then going to turn around and make your mortgage payment on that loan that you still have to the bank, and you'll be able to deduct the mortgage interest that you're still accruing or having, so that it's a wraparound. So basically they're taking it, they basically are phantomly holding the mortgage, the best way I can describe it, and paying you for it, and then you're turning around and paying. You're almost an intermediary in that. So that's really how that's going to work, Tusa.
Awesome. So let me ask you some intricate questions here then. So say, for example, I bought this property subject to, in a matter of 3 days, I sold it back to whoever this individual is. Am I going to be subject? But since I'm holding the second position note, which is pretty much a seller finance,
yep.
In that case, am I going to be charged with short-term capital gains?
Um, it sounds like you would. Well, are you selling the property or are you selling the note? Let me
That's
ask
a
you
great
that.
question. What happens in both cases?
Okay, well, are you? I would see how you would have a gain on the sale of a note, um, but the sale of a property, yeah, that's going to be short term. So that may be something that before you sit down and do this, give Tusif and I a call to say, all right, here's what's going to be happening with your taxes, because short term capital gains rates are going to be much higher than the long term one. So we may just say, can you sit on this for about maybe 364 more days? And see if we can't get it. Is what's your hurry on this one? So I mean, the selling of a note is also going to be a bit more complicated. So to sit down before you make that move, always talk to the CPA and say, all right, well, here's the tax effect that's going to happen on selling this.
Awesome. So this LLC can deduct the uh, mortgage interest of this sub-2 loan. Can this individual deduct the entire mortgage interest of this individual is paying to the LLC?
Yes, if they're
Awesome.
if yeah, that's if they're paying mortgage interest, yes, they can do that.
Awesome. So now let's talk about the two different scenarios. In the wrap, and if there's two scenarios where the deed, this is another document. In one case, deed is held by the LLC, which is pretty much the land contract.
Mm-hmm.
But this individual has an ownership interest in this property. Can he depreciate or claim depreciation on this property?
Okay, so what you all want to think about this is you all own houses, and the bank holds the mortgage on it, so they're going to have they're going to hold the deed. You don't own the deed, but you have a house, and you'd say even if you're in a business and you've bought a property and you've used bank financing, the bank owns your rental property until you pay off that loan, but you still can take depreciation on it because you're in business to do that, and you're making in event the thought is that you're going to pay that off at some point. So even though someone else is holding the note, they're holding this as security so that if something happens with the property or you renege on payment, they can take the property back and have the be able to sell it to recoup their losses. Now, something I've run into too. So if I was a couple of years back, I was talking to a banker, and I asked, well, what happens if I have a property here under my name and I want to transfer it to my LLC? What happens? And what he said was, well, what may happen is we'll call the loan, because we want to have somebody. If you're an LLC, there's nobody there to get anything from. We want to have somebody who's responsible for this loan. So before you transfer a personal real estate into an LLC, check with your lender and see what options are available to you to do that. So you don't get a note in mail saying, yeah, your entire $500,000 mortgage is due tomorrow, so pay up.
That's awesome. So just to summarize, even though deed is with this individual or this individual, of course, if this individual is using this property as primary residence, he's not claiming any depreciation in the first place. But if he goes into this one and subleases it or uses it as a short term, whatever, it doesn't matter if the deed is here or here. Whoever has the ownership equitable interest, not totally usage rights, but mainly equitable interest in it, that is the individual who can depreciate or claim depreciation or passive losses in this property. Awesome. Let's make it into another strategy that is called lease option. So instead of deed, we have same thing. We have another document that's just a lease agreement.
Yep.
Now, this individual, this LLC, is allowing this. I think I'm getting too clumsy. I'm just going to draw another house. So much for a single house.
Yeah, I'm not seeing a house on the screen, so I don't know if you have to scroll up or what have you.
I used to be not the best as art, but still not the best at art. But ended up passing engineering drawings for somehow. But
Yeah.
engineers don't care about the aesthetics ever.
All
So
right. So moving right along, let's go.
So coming here now, this LLC came here with a lease agreement with this individual. Now, this individual has the right to live in it, but does not have an equitable interest in it. Now, who claims what?
Okay, so the person leasing the property has no interest in it, so therefore you can't take depreciation. But the person who owns it is taking depreciation. And our last here's the distinction is that in the last example you're saying, well, Chris Joseph, you said the bank owns the note. How can they take depreciation? How can you take depreciation if the bank owns the note? Well, the expectation is that you are buying the house and you're expecting that you will be owning that house. The leaser, I hope I'm saying that right, is just going to go live there, but there's no intent to own the property. So therefore, you have no equity interest in it. You just want a roof over your head.
Awesome. What if in this case there's a second document that has an option to own it?
Okay, well, so then we're getting warm here, cooking with some barbecue sauce. The what's going to happen is that we'll have to take a look at the transaction and say, all right, so is a sale happening and when did it happen?
Awesome.
So that's okay. We need to sit down, take a look at the lease agreement, and see, all right, what's really happening here.
Awesome. So just to summarize, is for lease options, I know a lot of my viewers are very creative guys. For lease options, as long as the option is not executed, the current owner gets the losses.
Yes.
But the moment it is executed, that's when the current buyer or the renter becomes having the equitable interest. That's when he can start getting the losses.
Right, and it really comes down to intent and what your intention is with signing the lease.
Awesome. So
yeah, back in the the 90s when I was first doing accounting, there's a big thing, and there's an organization called the FASB, Financial Accounting Standards Board, and they were going back and forth about when something's a lease or when something is a purchase. 30 years ago, I don't remember all the debate about that, but it was a big thing to say, all right, when does this actually happen? So it's really, let's take a look at the contract and what does it say?
Awesome. So here's a great point that Chris brought up is intent. I know we have a lot of confusion. Of course, we spoke about the aspect of, hey, what happens if I go to Home Depot, I forgot my business card. We always recommend you have a separate account for your business expenses and your personal expenses. But if you have a business intent, IRS does allow you to take it even though it's from your personal credit card, even though that's something that we don't recommend. And we always recommend you to follow Chris's 5 basic rules: document, 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 document. But still, in case we are human being, if we end up in a situation, hey, I forgot, okay. If you had the intent, keep proper records. And then when you are going to the tax preparation or filing process, we can still claim those. Is that fair to say?
That is fair to say.
Awesome. Now let's make it a little more interesting. Is now, say for example, someone is as old school as I am. So instead of this LLC, now he comes out and says that, hey, this is going to be me owning this property. I'm going to own this however I want to own it. And I'm going to use all of these strategies. So now, say, for example, someone sells it. There's an interesting element that also comes out if you are an individual selling properties is NIIT.
Yep.
Chris, help us understand that part.
Okay, well, this was something that was put into the IRS put into, or Congress, in conjunction with the IRS, put in there, is to make sure that you were getting, you're being taxed on some of these investment vehicles. So it's going to be sales of the capital property, interest, and dividends. And so what's going to happen is that if your income is at a certain point, and I'm trying to take a look here because I have the chart here, is if there's a threshold for married filing jointly, it was at $250,000. If you're over that threshold and you're going to qualify for this, it's I believe 3.9%, correct me if I'm wrong, too. So 3.9% is going to be on your investment income. So just an additional tax is going to go along with that.
So someone who owns, say for example, I have a W-2.
Yep.
So for the sake of this example, let's say I make $100,000 just to make the numbers clean.
Yep.
And I sell another property where I have a gain of $200,000.
Yep.
So are you saying, since I have it on my name, I'm going to be paying, it's not my primary residence, so I'm going to be paying capital gains tax. Say, for example, for long term, it's going to be 15%?
Yep.
And on top of it, I'm going to have to pay on the same amount another 3.8%.
That's exactly right. And folks, write your Congress people and let them know that you don't like this. That it's and really, folks, that's kind of how the laws get made, is that or these rules get put in because people have hearings and decide to do them. But yes, it is an additional tax that's going to happen on what's considered investment vehicles. It's going to be interest or dividends and the capital gains, like Tusif just said. He just minding his business. He's making $100,000, and whoops, here's $200,000 he made on a sale of a property. Oh, great! Here's some more taxes for you.
So, folks, in real estate, if you are doing business in real estate, make sure to operate in an actual business. Let's not have IRS come in and say that, yo, have it into personal name, and since it's a personal name, you're actually increasing your DTI ratio, which is debt to income. And not only are doing that, on top of your capital properties capital gain, investment properties capital gain, you now also hit with another 3.8% unnecessary. I mean, unfortunate, as Chris also always mentions, write to your Congress people, have them say that, hey, help us drop it.
Yep. Exactly.
But up until the point that they're not dropping it, make sure to consider that if you are having this. But make it more interesting. What happens if I transfer a property from personal name instead of an LLC to a C Corp? Is that considered as a sale because this becomes a separate entity?
No, what's going to happen is that's going to be a cap called the capital contribution.
Awesome.
And this doesn't always have to be cash. It can be property. When we started a business, way back when I started mine in Tusif, we had a laptop. I'm sitting here looking at mine, not the one I bought in 2009, mind you, but we added that to our assets for our business. And it wasn't cash, but it was an asset. It was something that we could put into the business. And on a future episode, we'll talk about the sweat equity and how that works, as far as adding to the basis that you have in the corporation that you bought into. And that's gets a little bit more beyond what we want to talk about at 9:20 on a Wednesday evening before Thanksgiving.
Yeah, I know we are not going to make it this too long because we discussed so many elements. So we discussed today a lot of nuances of lending. We discussed about lease option. We discussed about NIIT, which is net investment income tax. We discussed about lease option. We discussed about RAP. And we discussed about also briefly about the real estate professional status. Where did that go? Wherever that is, yeah, there it is. We also discussed about real estate professional, the passive loss rule, where how much you can or cannot take. So if you still have any other questions in real estate, feel free to drop them. We are going to be having another couple of episodes in real estate, and if one or two, and after that, we're going to be getting more into other businesses as well. As Chris mentioned, we're going to talk about sweat equity. We're going to talk about capital risk, all those kind of stuff. But if you have any other questions in the meantime, feel free to drop anywhere to Chris or myself as well. And I really appreciate some of the names. I know some of my friends have been reaching out with a lot of questions. I really appreciate them. I appreciate your support, help. And if we could help out in any other ways, feel free to drop your questions or your concerns. And of course, I apologize for the great handwriting of mine. I was hoping to become, my parents wanted me to be a doctor, but I ended up becoming an engineer now, a tax professional. But we will be, I hope you guys are able to understand those. If you don't, book a call with us. We're going to explain those in details.
And probably not use drawings.
But I'm actually getting one of those touchpads. So most likely after the Black Friday elements, I should be able to get much better drawings as opposed to my mouse. I'm not saying my handwriting is great, but it should be better than this one.
Yeah.
Awesome. Chris, anything else you wanted to add today?
Well, folks, as I was talking about, don't make last-minute purchases to try and get a tax break. Talk to us about strategies before the end of the year so that you actually can use them to make money. Maybe it's a marketing program that's going to bring in more cash for you. Don't just make it for the sake of, I want to save money on your taxes, because you stop and think about it. Any kind of deduction on your business return is only going to give you about a 20% tax break. So why throw the money at it? But throw money at things that are going to bring in more money.
Awesome. Well, I really appreciate your time, Chris. Before this pre-holiday session to jump on this podcast, we'll keep it short, but I know we had discussed a lot of important facts. I really appreciate it, and thank you again. With that, we will be seeing you in the next one.
All right, folks.